Hello, Smart Money Few podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. So today I'm joined with Andrew Stotz. How are you doing today, Andrew?
I am doing great, Kirk. How are you?
I'm doing awesome. Really glad to have you back on the show. You're our three-peat guest. You've been on the show three times. Yes, I think you're our first three-peat. We're going to start bringing on our favorite guests more because there's only so many good people out there that we love listening to, and Andrew's one of them. So, Andrew, for those of you who are my newer listeners who don't quite know you, give us a little bit about your background.
Okay. I left the US in 1992 to come to Thailand. And I started a career as a sell side analyst for a broker investment bank in Thailand in 1993. So I spent 20 years in the Thai stock market, also as a head of research and looking around Asia. And then about 10 years ago, I set up my own firm called Stotz Investment Research. And I have a podcast called My Worst Investment Ever, where I interview people about their worst investment ever story. And in fact, you were episode 599. So for the listeners out there, if you want to hear Kirk's you know, awesome mistake, then just come to My Worst Investment Ever and go to type in episode 599.
Nice. Well, I could tell the listeners that that was a great episode, and I always love talking about my failures on the podcast. But I will say, you have probably, in my opinion, the best podcast name out there. Like, how can you beat My Worst Investment Ever? Like, it's a great title, it's catchy, and I mean, frankly, listening to you talk about all the crazy mistakes is great because that's how we learn. We don't learn from, hey, I bought Nvidia and it went to the moon. Like, you don't learn anything from that other than making like, oh, I can just buy stuff that goes up and make money. Like, that's not really how it works.
I
So
like the statement. I think it was Otto von Bismarck says, "Only a fool learns from his own mistakes. The wise man learns from the mistakes of others." And I was like, okay, that's front and center of what we're trying to do with the podcast.
yes, yes, and you do a wonderful job. So thank you for
Thank you.
contributing to the podcast universe here. Um, but let's just dive right in because I wanted to bring you on because you have some really interesting perspectives. And you know, most of my guests are from the U.S. and they're
Mm,
U.S. centric. Everything's U.S. based, and you know, everyone in the world has their own, you know, country centric point of view, so it is normal. But you were from here and then you moved to Thailand. So you've got both perspectives. So kind of what is your overall perspective of what's going on in the world, in the US? Like give us a kind of a high level of your thoughts.
So there's a few different things that I would say. The first thing is the last time we talked about what I call World War 2.5, which was the ongoing war at that time between the US and Europe. And now we can confidently say that the US has definitely conquered Europe. And there's no political leader in Europe that's going to stand up to the US at this point. And the US's control of NATO and the like, is phenomenal. So that was one of the themes that we talked about. And we can talk a little bit more about that and kind of what's the next war and how does that happen. But when I look at the world, I think from an investor outside of America, the first question is, when does the US market collapse and when does the US dollar collapse? Now, the collapse in the dollar for the typical American investor, they may not be so concerned about that because it's just not their thing. Of course, a smart investor may diversify their currency exposure by buying into other currencies, but which one are you going to buy? It's not that easy. So that is, the two things I think that most people are concerned about. And so that I would argue, and I guess the other thing that I'm just looking at is like, as we talked before we turn on the recorder, it's like, how long do we have to wait for this recession?
Yeah.
I thought it was coming at the end of last year. Then I thought first quarter. Okay, now we're going into we're in third quarter. How long does it last? And I think the other thing that's going on in my head is like, one of the things that's amazing that happened in China over the last couple of decades is that they employed the power of capitalism. Now they have a political system that's very different from the US political system, but from an economic management of things, they employed the power of capitalism. And we can see that happen all across Asia. In fact, if you look at the amount of stocks listed in stock markets across the world, the number one place where that number is going down is the US. Everywhere else, the number of stocks listed in stock markets are rising. And so there's kind of this abandonment of capitalism in the US that I think is another theme that, it'll be interesting how it plays out.
Yeah, and there's certainly a lot of reasons why number of companies in the U.S. are dropping publicly. Um, so how let's go back to you mentioned a bunch of stuff, so I want to kind of pick apart. So you mentioned World War II and a half. And we talked about that on the last show. Why do you say the U.S. conquered Europe? Aren't they our allies? Like, why do you say that?
Well, there are no permanent allies and there are no permanent friends and enemies in politics. So that's the first thing to always remember. But what I think the U.S. when the U.S. looks outside, I think every single country that they deal with is really a tool or an instrument to get their will done in the world. And I think other countries, that are smaller countries like Thailand couldn't ever even think of doing that. And so there is that aspect of it. And America's got the fight of a life, and that is the fight against China. And America sees that as a huge risk. Politicians, State Department, as a huge, issue. And I would argue they've blown it up probably way beyond what it needs to be, because I would argue that China is not nearly the threat that America thinks. In fact, if America had just taken $1 trillion of the money they spent on wars and invested it in infrastructure, education, making America the hotbed for learning and all of that, we would be in a very different situation. But unfortunately, America has squandered trillions of dollars over the last, let's say, 10 or 15 years. And now they're in a situation where it really is critical to try to knock down China. And I think that is the big thing that's happening right now. And in order to do that, you have to have control of Europe. And the reason why is because you need all the rules in this world are written by the US and Europe. There's no way that South Africa is going to come up with a rule about what countries must do. And therefore, you've got to have the control of the rule making in order to impose those rules on the rest of the world, number one. The second thing you have to have control of is the monetary system. You have to be able to shut people out of the monetary system. So if a little country like, let's say, Vietnam says, well, we don't want to do what you're saying, they'll say, well, then fine, you won't be able to access the US dollar, what I call the global, monetary system, which is a global US dollar monetary system. And that's a death blow. And so they need to control those things, the banking system, the political system, and the rules-based order, in order to basically force the rest of the world to go along with the war that they're on against China. And that's the way I see it.
Okay. Yeah, that makes a lot of sense, and I hadn't thought of it that way, but that's actually really interesting. So you mentioned China in that we shouldn't be as worried about them. China's an interesting country, and I feel like we basically built them up to be our market, so we could use cheap labor and they could build our goods. And now that they've become a second world, I wouldn't say a first world country necessarily. They're kind of on the border. They kind of are. They're kind of not in some ways. But their form of capitalism, put in air quotes. They're not quite communism. It's not quite capitalism. It's like capital corporatism. But I give them a lot of credit in that they're probably the most strategically minded country out there, even better than us. And no one likes to hear that, but I think they're very smart. However, they have also got problems, right? Because they got to deal with the people and all that. So, where do you think China goes from here? Because China moves slowly, and we kind of see that. It shouldn't be a surprise to anybody. We basically gave them the power, and now we have to fight. And I don't know why we did that, but we did. And so now they're a threat. So, how does that kind of play out from here? Because they're fighting. We're fighting to retain our control, and they're fighting for their own independence and control, and they're in some ways using our tactics against us. So how do you see that playing out with the US and China?
One of the things that I found really fascinating when I was studying my PhD at a university, the University of Science and Technology of China, and I was flying back and forth from Thailand and studying and meeting a lot of really nice people and interesting and very smart people there. But one of the things that I found really fascinating was their level of confidence was not nearly as high as I thought. Now, of course, there's nationalism, which every country is going to have, but that level of like cultural confidence, I think, is something that I was kind of surprised about. And then as I learned more of the history and saw the brutalization that they went through under the Japanese, the Russians at one point many years ago, and then the US, and then all of the different, and the British, and all of that, and also the wars amongst themselves. I realized like there was a really traumatic period for maybe 100 or so years that they've been recovering from. And so that I also think when I look at their ambitions, I don't see the ambitions like the US. Like they don't want to control the world. I think they want to be left alone. And I think that really upsets Americans and, or let's say, State Department, CIA, and the like. And I also think that they want to do business, and that's what they do well. And so, as I've said, when I talked about World War III is U.S. against China, I said that that would be in Africa. And the point that I was making there is that when America wakes up to the fact that China has now got control over the resources necessary to have the green revolution, to have, the war machines and all the things that they want, all of a sudden America is going to wake up and realize they've been outmaneuvered. And I think at that point, it doesn't matter what the ambitions of China are or not, America is going to respond. And I think that's really part of the spark that's going to cause the World War III.
Yeah, it's interesting. I mean, I've been noticing, I'm certainly not the only one, but I've been noticing China in their fight for resources in Africa for a while. And, it's certainly not on the surface. You have to like look for it. I remember there was a book when I was growing up. I was in my dad's library and he had this book, and I forget what it was called, but it was basically the resource war between the US and Russia in Africa, and it was happening with Russia back then, and we were strategically maneuvering for resources and all that, and it was really fascinating. And now it's not Russia, now it's China, right? And so you kind of see these maneuvers, and we're letting it happen. I mean, we've been doing it for
Mm.
decades, right, to the whole world, and we bring in our people, we cause a ruckus, and we bring in our people to rebuild. We pay our people to do that, and then we cause a ruckus somewhere else, and it gives us control, and then we lend them money, and they owe us, and then they're screwed, and then their currency goes down, then they're really screwed. They can't repay it, and it's just this continuous cycle of control. And now China's starting to do that, I've noticed. But what I've also noticed is a lot of these other countries, they're telling China to go pound sand. Like they never told us that because maybe we had more, going on to keep them tied up. But China's doing it, and I've heard like in the past year that a lot of those countries like, yeah, we're just not going to pay you. What are you going to do about it?
Right.
And so I don't know. Like that's interesting to me.
Yeah, I mean, the point is that what China's gotten is they've gotten the offtake of mines and other resources. I mean, the difference between Russia and China is that Russia is resource rich. So you could argue that what they were fighting for in Africa maybe was something a little bit different. Maybe it was ideology, communism versus democracy, or something like that. But now, as you look at Russia, Russia's very resource rich. Which I wonder if that has any reason why America's so intent on going after Russia. I wonder. But going back to the point, what's happened now is that China has got tremendous offtake of mines that are long-term, agreements that are now bringing the resources back to China and being processed. Because the difference between China and Russia is China does not have the resources. It does not have the oil resources. Does not have it has some mineral resources, but it doesn't have what Russia has, and it doesn't have what Africa has. And so I always just kind of laugh because in Europe, it's all about the EV and the green revolution. And in order to have the green revolution, you must have China because they are processing almost all the materials that you need to make the cheap vehicles. And then China brings in the cheap vehicles, the EVs that they desperately need for their green revolution in Europe. and now they've just put, they want to put tariffs on them and stop those from coming in. And there's a part of me that thought, hey, it's nice that the Chinese government subsidizes your transition to, electric vehicles.
Yeah, it's interesting. I heard, I can't remember if it was on the show or if it was my conversation I had with somebody outside, but there was an interesting conversation I had a while ago where I was talking to a guy and he mentioned this one strategy. And the strategy is this. Um, what if the real danger is China taking over Russia? Because China can very easily move north. There's nothing in Russia to protect Russia from China coming in and taking over the east of Russia. And none of their stuff's there. It's kind of wasteland for them. But there's a lot of oil fields, a lot of other stuff. China could very easily come in. And I heard a story a few months ago where they're talking about China's going to help Russia with their oil fields. And I was like, ooh, I said, that's smart on their part. As the US, what we should have done is we should have brought Russia into NATO and then had that as the bulwark against China. That would have been the appropriate thing to do. But apparently we needed an enemy and we thought it was Putin. And Putin might be a jerk, but he's not really the enemy. He doesn't really care. But China, on the other hand, is something completely different.
Yeah, and I disagree with that. I don't think China's after Russia, and it would be kind of ridiculous. I mean, Russia is such a massive landmass, and also a lot of the resources related to oil and gas are in the northern part of the of Russia. So it's not like just going over the border of Mongolia or the border of China is going to get them something that they need. And why do they need to take it over? They can do trade with them.
Right. Well, I
And
think the thinking was is that Russia at the time didn't have the resources to keep the oil fields open, and so they said, "Oh, well, we'll come and run it for you, and we'll do trade." So it was a trade agreement, but it's not hard to turn from trade if you got your people working the oil because the Russians they didn't have the resources to do it. All of a sudden, it turns in, yeah, we're just going to stay here, right? And so I guess it was more of a soft invasion than a hard one, and
yeah,
it's kind of like
I would.
Taiwan, right? I mean, you got Taiwan and they're fighting for Taiwan. It's like you haven't been a part of Taiwan for a long time. Like, go away.
Yeah, I wouldn't put much credence to that idea of
Okay.
China going into Russia. That would be my opinion on it. And Taiwan is an interesting one, where uh ultimately, I mean, the last time I was in Taiwan was probably, 7 years ago. And have a lot of friends there. And in some ways, the Taiwanese people that I talked to were just kind of waiting for the the inevitable. you know, Taiwan, I think that China is not in a hurry. And I think that what America is trying to do is raise this intensity that China's in a hurry and they're going to move any moment, right? I, I don't think that they see things in a lot longer time frame, but I
Yeah.
definitely think, that they see Taiwan as a part of China, and that just makes sense to them. So that one I would say is if America instigates something, then it may something may happen with Taiwan. But if nothing's instigated, I don't see that that's going to happen in the near future. But that's just my perspective.
You mean like Ukraine?
Oh,
I
you
just
mean
I
oh, wait a minute. I thought it was all
It's all
Putin's
Putin's fault.
fault.
Yeah, Putin did that.
Yeah,
It
yeah.
wasn't us.
Well, well, anybody, obviously, when you spend time outside of the U.S., you realize that almost every war that the U.S. has ever been in was started by the CIA,
Yeah.
and then they get America into trouble in such a way that the president has to then say, "Well, we've got to have our forces on the ground and fighting this, and we've got to defend our, interests." But and so I think Ukraine was no different at all, except it was CIA and State Department, and a great reading about the CIA and the history of Allen Dulles and John Foster Dulles just shows how the State Department and the CIA work so well together when it comes to attacking a country and getting what it wants out of that country.
Yeah, it's too bad, frankly, but unfortunately, they have too much power and there's not much you can do about it. But as you'd mentioned before the show, and I wanted to reiterate the comment because I thought it was very interesting, is you said Europe is the global exporter of compliance and regulation. What did you mean by that?
Well, look at Europe is on a high horse right now, and they're on a high horse of green energy, transition, climate change. We're all going to die if we don't do something now, and it's a bandwagon. And as I tell my students in my valuation master class that I basically say I've never seen a bigger bandwagon than the climate change ESG bandwagon. And I was working with some companies in Thailand, and one of the CEOs of the company said to me, he said it's even worse than a bandwagon. I was like, what do you mean? He says, if you don't join a bandwagon that's going through town, no problem. Everybody on the bandwagon and following it is having a fun time. They don't care. But if you don't join this bandwagon, you're going to be targeted and you're going to be in serious trouble. So it's not only the bandwagon, but it is the refusal to allow someone to be off the bandwagon. And a good example is the pressures that Germany has been putting on South Africa to stop coal, the use of coal. And now all of a sudden you have a very, very unstable grid that's causing blackouts across South Africa. I think about Thailand is an interesting example where they use the power of capitalism and they set up a lot of independent power producers. And they went through a period where they basically had a surplus of power and energy, and they still do. And those companies did make money, and they still do, although the profitability has come down because there's more of them competing. But the point is, I can't say that I've ever experienced a power outage in Thailand in 32 years. But when I look at what's happening in Africa in particular, where Europe is putting a huge amount of pressure, I mean, can you imagine? Can you imagine? The amount of global emissions coming out of Africa is about 4%. The people are in desperate poverty and they have no means of mechanizing their farming. So they're literally, in many cases, just using hoes and rakes and backbreaking labor. And Europe is telling them and convincing their leaders to also tell the people that we need to do this green transition and not use the fertilizer that we need from the natural gas, not use any of the power that we get from natural gas and from oil and from coal. It's just unbelievable. And so, but Europe, and this is part of why the U.S. wanted to get a hold of Europe too, is because Europe is the master bureaucrats that come up with all the regulations. And right now, the regulations that are hitting Thai companies and any company that wants to export to Europe, the regulations just keep going up and up and up about your climate policies, about this, about that. And in the end, many countries are eventually going to walk away from supplying Europe. But for right now, as as my first boss in the whole industry said, he's the one that came up with this, and he said it to me a couple of years ago. He says, "I'm long compliance." And the fact is, this is a world of compliance now. And it's unbelievable. If you think about when we grew up and we were just riding our bicycles around town, nobody knew where we were. We were in the woods running around. Nobody knew where we were. Now they must know. And it's even worse in America. I mean, you can say in many of the countries around the world, they just don't have a level of sophistication that American government and American politicians and American bureaucrats have. But in America, as we mentioned before we went on, they want your mind. They want to be inside your mind. And that just, it's terrifying.
Yeah, yeah, I have so many words to say about that. I'm going to try to keep them a little PG here, but I know the U.S. is very much the same. They want to own your thoughts and they want to control you. And actually, China's doing that too with their social score system, which is if you don't buck up to what we say, then you can't operate in this economy. It's like, well, that's not really a free market. And so, um, I have big issues with that. There's some parts of it that are good. I mean, it's not all bad. I mean, they're very anti-GMO, and I was doing some research, and the wheat and the gluten in this country has been hybridized, and it's not the same gluten that it is in Europe. And I go over and eat like gluten over in Europe. I actually don't have problems, but I eat it here, I do have problems. And so I don't know if it's GMO related, could be chemicals or whatever, but it's different. I've had beer over there, it's fine. Beer over here is very different. And
Mm.
so it's not all bad, but I will say the one thing that I do have an issue with is um, the energy stupidity. And it's not just limited to Europe. It's here too. So maybe they are exporting their stupidity here. But when you have Germany, who has a nuclear power plant shut off, which by the way is green energy, they shut
Mm,
off the nuclear power plant in favor of green energy that is not load power. It is completely just, wind and solar, and it requires wind and the sun to operate as opposed to just nuclear, which is always on. And then we get into war with Russia, and they don't get their gas, the natural gas. Now they got a big problem. To me, I have to ask, why are they so stupid? Like, if you have saber rattling going on with Russia, why would you shut down nuclear power, which is both green and cheap, and it keeps you from running out of energy in the winter when you're going saber rattling with Russia? It's like, am I missing something? Like, what's going on there?
yeah, and first, I just want to respond about China for a second. I don't necessarily like the political system of China, and I don't like being surveilled and all that. I do appreciate that when you walk into America and you walk into China, at least in China, they're surveilling you. In America, you'd think, well, I'm protected by the First Amendment, Well, no, you're not.
No, you're
That's a
not.
joke. And so, but the thing about the stupidity, what I always do when I teach a lot of classes, and I walk in, I often say it's a couple of questions I always ask the audience. I say, raise your hand if you trust your politicians. Nobody raises their hand. Nobody trusts politicians. And yet, when they say and do absolutely stupid things, people just go along with it. And I think that, most people, they just don't want trouble. They don't want a band of people complaining about them. They don't want trouble. Most people want to be left alone. And also, I think the beauty of this, this virus or whatever it is that's spread around the world is the idea that, you know, you want to feel good, like you're doing the right thing. I don't want to feel like I'm polluting. I don't want to feel like I'm, whatever it is, feel good. And I think that that is really, to me, what's underlying all of it, because most people don't have the guts to stand up to something. And so they just feel good by doing what they say.
Yeah. So getting back to the question though, with the energy, what are your thoughts on energy, where that's going? I mean, the
Well,
stupidity aside, there's plenty of that to go around, but
I
um,
listened to your latest podcast, in your episode, and I generally agree. In fact, what I would say is that politicians are so stupid that they're going to cause the supply of energy to be at risk. And I think that what's going to happen, it's very clear, is that the demand for energy is going to be enormous in the future. And in fact, since we last talked, I started a fund here in Thailand, which is Asia ex Japan ex China, because I wanted to be able to put China at zero weighting in the portfolio for my clients and have the flexibility to be kind of in and out. But one of the new funds that I'm working on is global power, and I just think that there's so much opportunity there, because for all the people that say that they want green this, green that, they're never going to stop using AI, and that is just an absolute power hungry thing. They're never going to stop using their devices and using the cloud and using all that. And so it's just going to be exponential growth in power demand. And these bumbling fools are going to mess up grids and mess up the consistency of power across any place where you've got it, unless politicians of their particular country are going to stand up and not be bullied into doing stupid things. So I think there is a good story in power.
so how do this question gets asked to me a lot. How do you invest in the new power trend? Because, you can invest in utilities. That's no fun. It's not going to do very well.
Yeah, so the way I'm thinking about doing it, and I've been doing some work on it, I haven't launched it yet, but the way I'm looking at it is just it's got to be a pretty broad opportunity set. So yes, there will be some utilities, there'll be some solar, there'll be some renewables, but then there'll also be uranium. I need what I need is not only buy stocks, I need to be able to buy ETFs, because I may not want to play in, let's say, uranium stocks or gold mining stocks as an example. I may decide to get that exposure there. So I'm looking at I'm looking at all different parts of the whole power ecosystem. And so I think that if I can build that portfolio, I would call that an exposure portfolio. I'm not trying to like outperform in that sense. I'm trying to build exposure to what I think is going to have 10, 15% average annual growth over the next 20 years.
Okay. Yeah, that makes sense. Yeah, it's interesting because I think that's the direction if you look at that. So one thing you'd mentioned also is you're sitting there wondering over in Asia when the U.S. market's going to crash. I've been wondering that for the last few years. So, what are your thoughts based on what you see from across the pond, if you will? How are you guys seeing it, and is it making sense to you? Because it doesn't make sense to us.
No, I don't think it makes sense. I mean, I think the only way that you could say it makes sense to someone outside of the US is that they just know that the US has so much political and military power, and you can hold your position as the king of the hill for a very, very long time. And I think that's what most people see. There is no challenge to the military and political power of the US. As far as the way I look at it, we're struggling over here. One of my businesses here is a coffee factory where we're roasting and selling coffee B2B. And strong dollar has just been so difficult for Asia. And so Asia's getting, really hit hard on a strong dollar. The imports are, just been getting more and more expensive. So in Asia, the first thing that we feel oftentimes is the dollar, particularly because there's many energy importing countries that are importing in US dollar terms. And so the products that they're buying are in US dollars. So that is the first thing. And I think that my conclusion and what I tell my clients is that I can't really tell. Is it 6 months or 6 years before the US dollar really starts to collapse? I just really can't tell at this point. I think that one of the things that an investor needs to do is make sure that, particularly outside of America, they need to make sure that they've separated their US component from other components of their portfolio. So I look at stocks, bonds, commodities, and gold. And within my stocks area, I'm looking at allocations to either US, Europe, Japan, emerging markets, Asia, China, these types of areas so that I can weight that. And what I've got in my total portfolio, which is, I would say it's a relatively moderate risk portfolio and it's buying ETFs, not stocks. But basically, I'm 65% weighted in equities right now, 5% in bonds, and 25% in gold, and 5% in commodities right now. And within the equity 65%, I'm only 5% of my total 100% is in the US. So I have been trimming that position. It's hurt me a bit, but some of the other markets have done okay. So it's not hurting that bad. So I think the first thing is make sure that you've got a good separation between your US exposure and your non-US exposure. The second thing is that it's not in the stock market in the US, it's not really the stock market that's so expensive. It's the cream of the crop. But if we go down to Russell 2000 or something like that, it's a whole different world, where the valuations are, interesting. I think they're cheap. The companies are struggling for sure, definitely. But I do think small cap quality type of thing is something that is probably worth having a unique position in rather than just S&P 500.
So it's interesting you say that because I think one of the challenges that we've seen for like the last 15 years at least is the market is pretty much bifurcated. There's the cream of the crop and then there's everything else. And you can look at that for US international. US has been the place to be for like 15 plus years. You can't invest in Europe. Europe stinks. Like, maybe, but it's basically within a range, a big range, but within a range.
Hmm.
Emerging markets not great. It's there's all these places. I mean, China's hasn't done well recently. So you get all these places and the US just keeps plugging along. It just can't do no wrong, even though we've been through a place where we should have been in a recession, air quotes, in a recession, even though technically they didn't count it. And we get to these places where people just shove money here, right? It goes up because people are buying, right? And if more buyers than sellers, it goes up. It's more sellers and buyers, it goes down. But we seem to continue to float on this bubble in the US. And if you look, like you said, at the cream of the crop here, if you look at the mega cap tech stocks, they're also floating on a bubble. Everything else is kind of just flatlining, right? It's for the more or less, if you look at it equal weighted, not all the time, but it's been really a big flat line. And then you
Yeah.
got the Russell 2000, which hasn't done great at all in comparison. So um, when you're looking at that, uh, why bother investing in anything other than the Magnificent Seven when they're just not pulling their weight? Because
Yep.
they could be undervalued, but they could be undervalued for 20 years. So what's an argument that people can kind of hold up and say, yeah, this is a good idea?
So, this is where my worst investment ever podcast has been helpful for me because it helps me to kind of make sure that I'm not making some common mistakes. And, there's a group of them, but the one common mistake that I think most people make is a lack of diversification, and position sizing is a big part of that. And so I think one of the things that I remember when I was younger in the business was that, that feeling when you really get confident about a story and you build it up and you now really feel confident that, I should be buying Argentina. And then when you get that story, or I should be buying gold as an example, when you get that story and that confidence, what do? Put it all down on Argentina and gold or whatever. And nowadays, I understand that I don't let my ideas about what's going on in the world, my themes and my concepts, I don't let them cause me to be overexposed to any one of them. And so I do moderate my positions in such a way that I still have some exposure. Now, there's occasional times where I'm going to an extreme, like only having 5% of my overall portfolio in the US right now is pretty extreme. That's 5% out of a 65% equity. So it's more than a 5%. But the point is, I'm seriously underweight the US right now. But the point that I'm trying to make is that, you know, it's easy to get sucked into a theme or an idea and it makes sense to you and then you put all the money down. So I would say the first thing we have to do is make sure that we build, reasonable exposures to these things. The second thing is that we need to have the ability to switch. And sometimes we find that, people just don't have the exposure to other regions and other markets. And the third thing I would say is that um, just because China's bad or Europe's bad or gold's bad or commodities are bad doesn't mean that I wouldn't be willing to allocate to it if I saw some momentum and some opportunity there. And I think what happens is that we get blinded by the fact that we see all the badness out there, and therefore we just don't do that diversification. And so I still try to always build a diversified portfolio. And from my perspective, it helps me particularly on one side, and that is when the markets go down, I tend to go down less because of my gold, bonds, commodities, and my diversified exposure worldwide. So that's kind of the way I look at it.
Okay. Yeah, that makes sense. I think the challenge with most investors is they see one thing in comparison to something else. So they see Tesla and Nvidia up like hundreds of percent, and they compare that to Coca-Cola, and they're like, "Why are we in Coca-Cola? Why aren't we in Nvidia? Because that's going up
Yeah.
and Coca-Cola is
And
not."
and and they're looking at the past.
Right. Right. Yeah, no, you and I are on the same page, Andrew. I'm pointing it out for the listeners because it is as a money manager, it's hard, right? Because you're telling them, "Hey, I'm right and everyone else is wrong." Right? You're saying that this is a good company, we should stick with it versus, "Hey, I want to take a ride on that rocket ship that's going straight up." And you have to justify that, right?
Yeah.
And you there's no way you can because it's not rational. And if somebody has any inkling of I want to watch my statements today, or I'm going to look at my account, it's like you're never going to win that battle. And it's hard as an investor because you want to see your accounts go up. And like these things are going up 100%, and a good company might go up 10% a year, but it's nothing in comparison to 20, 30, 40, 50, 70%, right? And so it's really hard um to psychologically accept that.
Yeah.
And you're right. I mean, that's the issue. Because of course these things are going to crash too, but people don't think that because it's up now.
Yeah, so I have a slide I always show when I present, and it's a slide of me as a baby, and then me when I came to Thailand in 1992, and then me at 100 years old. And I say, I'm building these strategies for decades. and I'm always saying decades. And my purpose is that the man or woman who wants that trade in Nvidia is either going to take all their money and go do that trade, and they're not going to come to me because I'm telling them decades, or they're going to say, okay, for the safe part of my portfolio, I'm going to give it to Andrew or follow Andrew's strategies. And then I say, go play in Nvidia with 10% of your portfolio and go play in crypto and all those different things. Enjoy. But I still am trying to manage for decades. That's my focus.
Yeah. No, it's the right way to think. It's just it's hard for investors to really wrap their mind around it because it's too long and everyone's used to the dopamine hits and all the problems we have with our instant gratification. So when do you think a recession is actually going to happen in the US? Like if we're looking at timing, I've mistimed it for the last year and a half, and I think a lot of everyone else is doing the same. They're scratching their head and they're thinking like, yeah, we should have a recession when old Joe Biden said we didn't have a recession, even though we did technically. And they said, no, it's not a recession. And I can see both sides. Technically, it was a recession, but there's also some parts of it which are kind of like, well, or also it's not the normal recession. So when do you think a real recession is going to hit the US? Because we seem like this bubble is just going on forever. It's well past
Yeah,
its prime.
I thought, as I mentioned earlier, I thought it was going to be the end of last year. I thought it was going to be first quarter. Then I thought it was going to be second quarter. And usually when you're just about to give up on it, it's probably the time that it comes. But what I would say is that one of the things I think I did underestimate, and that is that uh, if you remember back, I think it was in 1987, we had the flash crash in the
Yep.
stock market. And it was called the flash crash because it just happened briefly. It was a flash. And I think it's possible that, if we remember, Peter Schiff always says the recession is the cure, the bubble is the illness. It's not the other way around. The recession is there to clean out the excess supply and all that. It could be that during the COVID shutdown period that we had a flash economic recession. And it was such a powerful lightning flash or laser flash that it wiped out millions of businesses right off the bat. And maybe the work of a recession to wipe those businesses out just couldn't happen anymore because it already happened in a flash. And then that activity accumulated into the largest companies, and then things have kind of taken off. So I do think I estimated the amount of damage that did, and maybe that flash GDP crash caused the unlikelihood, the likelihood that we wouldn't have such a deep recession. But having said that, I think that I wouldn't want to be a presidential candidate coming into office when we've had this all of the spending and all of the government spending and and all of the vulnerabilities I think that are in the US. I think it's going to be very, very tough. And I would say that we probably are 3 to 6 months away from, and I still think we can see it in this year.
Yeah, I always see it. It's hard to see beyond 3 months in this economy. It's how our economies run is, 3 6 month cycle. Um, I do want to ask though, I actually like your framing. I think that's a good way to think about it. I hadn't really thought about it in that way. I mean, of course, COVID was a recession, but honestly, I just never thought of it as a recession. I just thought of it as like it's a crash. It came back, everyone was fine, but it's not like the 2008 crash. It's like that was clearly a recession, right? The COVID was, yeah, it was a recession, but just in my head, I don't think of it in those terms because it was just so different. But I guess it was, and I mean, that is the nature of our economy, is that we have crashes, not recessions. And crashes are a quick way to have a recession, so we don't end up like Japan, which is a 35-year recession. Um, but I want to ask because I know we're kind of coming up in time here, but we have an upcoming election, which has been pure comedy for the memes. I have to say, I'm in it for the memes. I'm not not in it for the politics.
Mm.
But we have an upcoming election. Um, how do you think that's going to change the US? And more importantly, what does the world think about it from people you talk to?
I think the world is kind of baffled about all that's going on in US politics. And so I think that's the first thing. And, I I have a client base here that I went out to about a year and a half ago and made my prediction, which was Gavin Newsom in 2024, or starting in 2025. And I was right in the sense that it wasn't going to be Joe Biden. And I still think there's a possibility of it because, we'll see what happens. But um, I would argue that U.S. is kind of in trouble at this point. And um, my point, the reason why I said that the Democrats would win is because they really will do anything to keep Trump out. The level of hatred and the bitterness and resentment and the kind of almost evil nature of what I thought were reasonable people. Now I talk to people, whether it's in family or outside, I thought, I didn't realize that this person can be so resentful. Like I I don't particularly like Biden, but I don't hate him and want to do everything I possibly can to destroy him. And there is that obvious, it's obvious now in America, and with the lawfare that was going on, and then somebody trying to kill him. It's just like that to any lengths. And I think there was a great article in Time magazine during the last election, which explained very openly how the Democrat Party and the leaders that were against Trump pulled together to try to pull every resource to make sure that Trump didn't get it. And I think Robert Epstein is one of the great ones in the US that has been tracking Google and social media to try to understand how they're manipulating and swinging votes. And so I think it's pretty much impossible if the social media companies and the media companies are able to pull the strings to the level that they've been able to do in the last election. I would say it's pretty inevitable that Donald Trump cannot win against that. And of course, if he's killed, he won't win. And so that's the reason why I say, although from a Donald Trump supporter perspective, that seems crazy because there's so much support. And now, since he's come out of the assassination attempt, it seems like it's a shoe-in. But I think that the level of hatred and resentment that I've seen in what I thought were pretty reasonable people, it terrifies me. That like doing anything to prevent it.
Yeah, I think that's been a problem for a while is the corporate media has whipped. They've basically gaslighted and lied to the Democrats for years, and the Democrats have just bought into the BS, and they think that whatever's out in the media is true, and that all these media sources are accurate. And it's been clear to anybody who's not caught up in this whole thing that they've been just lied to.
Mm,
From all these stories, all these, basically, I mean, you go back to all the hoaxes, like they're all basically hoaxes. If you go
yeah.
back, you just debunk them. Like they're all debunked now. You can go online and see, like, clearly a lot of the quote unquote hoaxes when Trump was president were hoaxes. And they've all been debunked and they're out there and they're not just by right
And
leaning,
there's
even by the
more
left
coming.
side. And there's more coming, right? And they keep gaslighting their own party. And at some point, like they're just so in the bubble, it's hard for them to see. Um, I see it because when people talk to me about like, what do you think of ESG? What do you think of this? I'm like, what do you think of global warming? I'm like, I don't know. I'm not a scientist. I'm not a global warming scientist, so I couldn't tell you. And I think even the global warming scientists don't know because what is required to know all that information is too large for any of us to understand. So I just look at the structure of propaganda, right? I know what propaganda looks like. You can easily identify it. You can go back and look at history. It's all over the place. And when you see the same structure, what I see is this smells like BS. I don't know if it's BS. Like I'm guessing, but like when you see it, you can tell there's the same structure every single time that it follows. And it's like, oh, well, this looks a lot like that, so I think it's BS. There's no way for me to know otherwise, but it immediately my antennas go up. So
I wanted to highlight one last thing that I think is critical for my friends in America, and that is uh, our last hope of freedom for the world has always been America. That's not going to come out of Russia. It's not going to come out of China. It's not going to come out of Bulgaria. It's not going to come out of Italy. It's not going to come out of South Africa. Ultimately, American is the last place where you have true freedom. And the bulwark or the only final resistance to that, in my opinion, is the republic structure of the US government, and that is the states. Many people who don't understand the electoral college don't realize that it is a union of states. It is not a union of people. And that is the saving grace. The powers of the states relative to the federal government is stronger than in any other country in the world. No province in Germany or in Thailand, as an example, no governor of a province is ever going to be able to challenge the central government. But in the US, they can't. And so this is why the electoral college is so important for the US. And it's the reason why the states, if anything, if there's any fight against the loss of freedom, I think it's going to come from the states. And this is one of the reasons why I think you could argue that there is some sort of civil war or splitting that happens in America where certain states decide we will not comply with these federal regulations. And it already happens in some states when it comes to not complying with ICE and things like that. So I just want to say for the states, stand up, because you are the last bulwark of freedom in this world.
Yeah, that's a good note to leave off of, and I agree. I think both parties take advantage of this, where they just say, "Go pound sand. We're doing what we want." California does it, where they export their regulations compliance to other states. You've got some of you've got certainly the Roe v. Wade, where some states are like, "I'm supporting it," some states are like, "I'm not supporting it," but they have the choice, right? That was the whole point of the Supreme Court decision, to push the choice back to the states. It didn't say it's allowed. It just said the states get to decide, which I think was the appropriate way. But I understand the issue is obviously a hot issue. So I guess as we kind of wrap up here, where should people be thinking about investing in the world right now? Like, where are the opportunities? How should people be thinking about those opportunities? And where would you be putting new money today?
I personally, I in Asia, I just see the economies growing, people striving, and so I'm particularly interested in what's happening in Asia. I think one of the ways to look at it is the ASEAN countries or Southeast Asia. One of the reasons why that's good is that you don't get the exposure to the volatility and other issues related to China. And so therefore, I think countries like Indonesia and countries like Thailand and countries like Philippines, and these countries, I think, have good opportunities and good growth in population and just generally good growth with a lot of desire to grow their incomes. And so I would say Southeast Asia also, although it can be whipsawed with the US when it goes down, it also is not absolutely beholden to the US and the US market. So I find that area interesting. So of course, I'm also, as I mentioned, pretty heavily weighted in gold right now. But I would say, be diversified. That's the key.
Awesome. Well, Andrew, always appreciate you coming to the show and sharing your wisdom with us. I'm gonna let you go. I gotta get to bed, and you gotta get to work. So,
Exactly.
but thank you again for coming to the show. Where can people find more about you?
Just come to myworstinvestmentever.com and I'm there. And you can also contact my contact page there. It sends an email directly to my personal email.
Awesome. Well, once again, Andrew, thanks for coming on the show. And you're going to be a four-peat. You'll be back.
The excitement never ends in this world, so there's always something. I appreciate you having me on, and thanks for all the listeners and viewers for listening.
Awesome. Well, thanks again.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Andrew. Really appreciate him coming on the show. I always love having Andrew on. He's a breath of fresh air, especially from somebody who's not living in the U.S. I find that we always have our own lens on the world that is very domestic centric and very U.S. centric, which is both good and bad. But it's always nice to kind of change the lens around and get different perspectives from different people, because sometimes they have a different view that is better than our lens on the world. And Andrew's done a great job. So once again, thank you for being a three-peat. Let's get into the panel portion of the show. We're in the summer, so things are a little light. Everyone's on vacation, so it's just me and Doug. So Doug, welcome to the show.
Thanks, Kirk. I always appreciate the conversations, like you just said, with some of the people that have a different perspective on different parts of the world. I go back a little bit to one we did to probably about a year and a half or so ago. I think also living in that part of the world. I think it was an American living in that part of the world, but seeing the impact of the global trade from a completely different perspective than you get to see sometimes when you're stuck within the inside of our borders. You're living off of U.S. dollars that you earn and spending those U.S. dollars here, which of course we do feel the effects of inflation, but you don't see near the perspective that you see about how it relates, and especially the dollar on a global standpoint. Unless I think you kind of have a familiarity of it and you look at it outside, where now you're getting into currency comparisons and conversions, which and then of course that impacts trade and everything else. I think it's always fascinating, those perspectives.
Yeah, great. Well, appreciate your perspective here as we kind of get into this. So, we talked a lot about global investing on the interview, and I know we talked about it, but I'll come back to it because I want to get Doug's opinion as well. Is when we look at global investing, in my experience, I remember when I started in 1999 in this industry, there was a period which seemed to mark 10-year cycles, which happened to coincide with the aughts, right? It was like, 1980 to 1990, 1990 to 2000. And there were these decades where international outperformed US, or US outperformed international. And it would alternate, right? It was like one, then the other, then the other. And then just kind of stopped in the 2000s, because in the 90s, international, oddly enough, outperformed the US. And you think, how's that possible? The US did great. International did better. And the US did better before that. And then the 2000s, US did better, which is normal in the cycle. But then the 10s, it didn't, right? It kept being better. And so the fascinating thing that I find is, money typically flows back and forth around the world, but money has basically been sticky in the US for decades. And what's interesting about that is why. And you think about it, like basically after 2008, like it really demolished the international financial systems. I mean, countries like Iceland were buying shoddy paper and got blown up, and all these countries that just were trying to hunt for extra yield got kind of imploded because of our problem that we caused, and we caused it. And so I think we can honestly take the blame for that because our financial system created shoddy paper and no one knew the repercussions and everyone thought housing always goes up. And hey, everyone else thought the same thing. Well, housing always goes up. And that was the one thing that brought it down. So anytime you see everyone relying on one thing being true, you can guarantee that one thing is not true. And at some point it won't be. And then you're going to have a big problem. So, but the point is many international markets haven't recovered. Now, Japan has. Japan's actually done really well in the last few years, but for 35 years it did very poorly. In the last few years, it's done well. Europe is just kind of in this languishing period where it's just kind of going sideways. Goes up and down, but it's basically sideways, which is kind of what happened to us in the 70s, which is during the 70s, we went up and down a lot, but it was basically sideways for like a 14 year period. And so when I look at, different places in the world, where do you invest? I mean, China is not a place I have ever felt comfortable with because China does not have the property rights that other countries have. And when you don't have property rights, then you don't know if you own the stuff. You can invest, but then China just says, you know what, we're going to take that from you because we decided to. That's not a recipe for success in financial markets. So they went through a period where they started making billionaires disappear, and the markets got a little skittish, and basically they said, we're going to crack down on a bunch of stuff, and I forget exactly what it was, but basically the markets kind of went south, and then they realized like, oh crap, we gotta fix the system, or there's going to have a real problem. So they said, all right, we want your business again, and everyone's like, nah, we've seen this story before, we're good, we're not going to do it. So the market hasn't really recovered in the way that you would expect it might. But if you look at all different parts of the world, there are parts of the world which are good, and there are parts of the world which are sketchy. And I think the challenge is, where do you put money that is going to get a return that's commensurate for the increased risk, right? So you go to like Brazil or Chile or Ecuador or Greece or wherever. You go to these different countries all over the world, and you say, all right, what is the probability of me outperforming the US? Like, let's use the US as the central part for our conversation here. Let's say the US is the base case, right? Doesn't matter what it is, it's the base case. It's zero. Like, zero is what you get for the US. Now, the question is do you invest in Greece hoping you're going to get +1 without an increased risk, right? But if your risk is +2, okay, that's not worth it to get a +1, right? You want to keep them equivalent. So the U.S. is zero risk, zero return, and Greece might get a +1 in return, but might have a -1 in risk, which means there's no advantage to going with Greece than the U.S. So if you think of it in that term, just logically, just as we're kind of mapping it out in our head, we're trying to map out like, what is the pro and con of investing internationally. Now, I don't see any place in the world it's like, oh my God, this is a no-brainer, except for maybe India. I really like India. They've got some problems, but Modi's done a great job over there, and they've done a great job to fix some of the challenges they have. So I think India's got a good long-term economic success ahead of it, but short-term, who knows? So I think you have to look at these countries and say, why am I investing here? Am I investing because it's going up, or am I investing because the opportunity set's great? I don't see a lot in Europe. I don't see a lot in China. I do see some in Japan, because Japan has I see some problems there too, for sure. But I think if you do it right, there's some ways to hedge that. And still the U.S. Like Canada, I'm a little fuzzy on. I'm hearing some bad stuff about Canada, but the U.S. is still there. I think we're overvalued, but for the risk-reward trade-off, it's at least something that you can feel comfortable with. So I think you really have to understand the risk-reward trade-off when you're investing internationally. What do you think, Doug? I mean, when you're thinking about this, like, how do you see international investing compared to the U.S.?
So it's really interesting. So there's a software out there that I'm not going to name that became extremely popular for a period of time, and it may still be popular for analyzing risk of portfolios. A lot of financial advisors have used it to assess risk assessments and such. And one of the things that this software actually would do would be able to take, and what you could do an optimized setting. So okay, based on the risk, volatility, et cetera, blah blah blah, it would then take the portfolio they have and say, okay, we recommend this one. And one of the things that I always found interesting about it is that when it would put out the recommended risk profile for portfolio, it would significantly weight heavily towards international, which typically your long-standing static portfolio allocation, which I know, Kirk, will have quite a few counter arguments against. But let's face it, these still get used every day by many, many, many people in the industry. Would generally said, X amount S&P, X amount, or X amount to large cap, growth, value, or whatever, and then small cap, and then mid cap, and then international bonds, et cetera. Oftentimes in those static portfolios, and you can go into anybody's 401k and look at some of those target date funds and things and see how their institutions are breaking it down. A lot of times you're going to see a static average of just putting 10, maybe to 20% max into international. There has clearly been a bias towards putting an allocation towards domestic equity here in the United States. But this risk assessment and this analyzer kept coming back and pushing a much greater allocation to international. I mean, closer to, 40%. And the reason that they would come back with this, again, not a pro or a con, is that when they started to look again at the risk-adjusted volatility of international over the long run in relation to United States equity, international tended to be a lot less volatile. Okay, and that's not everything that necessarily had to go into that argument. Now, the problem you get into is it's pretty easy to break down the United States equity into three categories: large cap, mid cap, small cap. Okay, now you can go growth or value, and we've had plenty of arguments for whatever that means. But it's a lot harder to quantify what international is, right? Because when you're dealing with one country, one currency, one Fed policy, yes, small caps are, historically small caps very much, they're built in the United States. They're going to be dependent exactly on what we have. As we got larger, over the past 20 years, though, we saw a much more global expansion. I think that's changed a lot of things, certainly in terms of the impact of domestic U.S. large companies, because as the middle class in the United States has shrunk, the middle class in the rest of the international world has become much more influential. And that means that their buying power is going to have much more impact on these large global scale companies. And that brings into play a whole different variance of the impact of the currency. So when you're thinking about internationally and even global companies, you got to think differently about this, because it's not just small cap, mid cap, large cap. It is, because most international investing tends, and again, if you're out there in your 401k, a lot of the international investing defaults are kind of the same companies that would be here. Like, oh, hey, large company here, Nestle. Well, that's an international company, but it's on the same global scale as a 3M here, as a large, or a Hershey's here on a global scale. When you start getting into small, international, you got to think, what is a small cap going to deal with in the company or in the country they're in, and their currency that they're facing, and their government and their policies? What is a mid cap company going to deal with? What's a large cap company deal with differently when their currency? Are we looking at that US dollar hedged and then putting everything on equal scale? Or are we doing that US dollar, or not US dollar hedge, which means how does the impact of that currency impact those companies, and do they sell only inside their companies or countries or regionally, or are they selling to the United States? I think then you start getting into where is the global shift happening between developed countries and underdeveloped countries. And that's when we started to get into things like emerging markets. And you had your original FANG stocks, which were, I'm sorry, not FANG stocks. I was wrong one. FANGs are your technology companies here. But you had your, what's the term for it? The old emerging markets company, the BRICS. Sorry, the BRICS. It was like, oh, it's Brazil, it's Russia, it's India, China. Well, you go back 20 years, 30 years, that was emerging markets. We were coming into a situation in which those economies were really going to be poised to take off. Now you look at something like at least China, for example, and would you call it an emerging economy anymore? Probably not. I mean, they are as globally positioned, as any, established European or U.S. U.S. country. So now you got to think, well, what is emerging markets these days? It's changed. Like there's new countries that are going to be the next wave that would be positioned to be coming up. And so international investing is very hard, Kirk, to just throw into a category, right? Oh, it's international investing. There are so many different variables at play. And this is where the currency thing comes in. I mean, he's talking about the decline of the US dollar. It becomes much, much more sensitive as to whether or not our dollar is strong or their currency is weak. You saw this in Europe when they did the euro, right? All of a sudden, you had currencies all over, the liras, the francs, all of this was dependent on each country's individual currency policies and government regulatory policies. All of a sudden they get together and they combine, and the GDP of the combined output of the European Union all of a sudden became very comparable to the GDP output of the United States. Now, you're still comparing a continent to one country, but as they were acting as a coalition, that changed things significantly, and it created the euro, which all of a sudden is a currency that was equal to, if not for a while, strongly or greatly stronger than the United States dollar. That changed, that certainly then created a different situation when regards to trading with Europe and the United States, and how that would look as those currencies now one-to-one shifted versus, hey, am I trading in Germany and I've got the mark versus I go to, trading in France and I've got the franc, now you had that one situation, a significant economic, a shift there. And then you also deal, like you mentioned, with China, and, people have talked about currency manipulation. But now let's come back to the dollar. If the dollar strengthens and these countries are buying and trading in dollars, it's going to be difficult for them, right? It's much more expensive because their local currency isn't the dollar. And if it devalues against the dollar, all of a sudden that becomes a trade headwind. It's much more expensive to buy, right? Because they don't have the dollars. They got to convert their money into dollars, much more expensive to buy that. They're going to be able to buy less goods. So as the dollar gets strong, global players like, American global companies are going to see headwinds when if they're relying more and more on those foreign middle classes. Now, the opposite is true if the dollar declines and their currencies increase. Now you get into also the geopolitical. You talked about not being able to own property in China. The same thing happens, again, a lot of areas of Latin America. Who's able to own property, who's not able to own property. Foreign investors that go into certain countries, they get 30-year leases. They can't actually invest and grow and buy property and then have that foreign investment. So, it comes down to international investing is exceptionally complex. It is not, and I think it's been watered down into this very easy, it's like the bond market in a way. And I'm not saying bonds and international are the same, but the way it's been kind of lumped into a category, it's like, I've got large cap, mid cap, small cap bonds. Well, you and I know this, Kirk, and we've talked about this all the time. What does that mean? You've got revenue bonds that are based off of like tolls. You've got, government bonds. You've got, these are municipal. You've got tax-based bonds. You've got corporate bonds. You've got different types of corporate bonds. You got floating rate bonds. And we just talked about this in another podcast. What is it? Over $1 trillion, several $1 trillion is the bond market. Well, so when we tell people, in your allocation, just allocate 20, 30, 40, 50, 60, 70% to bonds, that is an incredibly watered down conversation. And I would say at the detriment of investors, we spend so much time talking about the 30 trillion, the 30 trillion, I know I'm getting my numbers wrong, $30 trillion stock market versus the hundreds of $1 trillion bond market. But then we get very detailed, small cap, large cap, QQQ, NASDAQ, it's really easy, small to do this. But then when it comes to international or bonds, we just say, throw it in bonds, throw in international. And I think that has maybe worked in the past when the United States had so much control over the global stock economy. That is shifting, as we all know. The middle class of other countries are rising. Countries like India are becoming more, and China are having more influence. We've got the, obviously the dollar is no longer hedged as the global, currency for oil. And because of that, I think if we don't start now talking about, investing international or investing bonds in the same type of divided way that, and granular way that and detailed way that we used to get with domestic stocks, I think that's a real problem that needs to change, because you cannot make this a vanilla conversation.
Yeah, no, I agree with that. And I think it's interesting because, pretty much up until a few years ago, no one was talking about bonds at all. And advisors were putting bonds in people's portfolios and saying, oh, you got bonds. And they're like, oh, okay, that must be safe. And of course, if you were in 30-year treasuries, you lost more than 50% within a year. That is not safe, right? And now, if you were to hold that for 30 years, then yeah, sure, you were safe. But it really wasn't a safe investment. And I think some of the challenges, people don't truly understand bonds. And because the conversations back in the 90s, people did. Like, people were doing all sorts of stuff. They were looking at CMOs, CLOs, or doing all this weird stuff. And everyone understood bonds because you could get a reasonable rate of return from bonds. You could get a 6, 7, 8% from a bond. And it wasn't 30% you were getting from the markets because everything was all tech all the time. But if you're a retiree, you really liked that 6, 7, 8%, bond yield. It was pretty nice, right? And people were hunting for yield. And if you look at something like I can't remember the name of the company. It was the British oil company that the ocean floor, they had an ocean leak, and
BP?
was it? No, it wasn't. Was it BP?
It's BP. BP was the one, and blue, whatever, Deep Horizon, that was BP.
No, it was before that. This is back like maybe 10 years ago when they had the underwater pipe and it burst and they were trying to stop it and they couldn't stop it. Was that BP?
that's the Deep Horizon platform.
Oh, was that BP?
Okay. And that BP was the one that behind that. Yep.
All right. So BP, and I'm saying it with a caveat because I feel like it's another company, but if that was it, that's it. Anyway, so they had like a 7% dividend, and you had a bunch of, they call them pensioners over there, retirees. I think the pensioner is a kind of funny term, but basically retirees over there, and they were living off that income. They had BP stock because they were getting a 7% dividend. Then that happened. The dividend went down like through the floor, and then you're like, how am I going to make any money? And it wasn't a dividend, right? I'm sorry, it wasn't a bond payment, it was a dividend. So the dividend wasn't safe, but people were taking that extra risk because, hey, it's BP and nothing will ever happen. Well, of course something happened. But if you were in the bonds, that payment would have been stable, right? So bonds have a really interesting setup where most people, they're really simple, but most people truly don't understand how bonds work. And they don't understand the types of bonds you should have for certain times. It's kind of like you invest in stocks if they go up and you get out of them if they go down. It's real easy. With bonds, it's different. And depending on the markets, depending on inflation, depending on interest rates, there's all these factors that go into the pricing of the bond and the interest rate. And depending on the bond, it might get more complicated, like a tip. Very complicated, so much so that I still don't understand how they perform. I understand how they work. It's really easy. But when I look at the performance, I'm like, that performance doesn't make sense. What am I missing? I talk with people who specialize in this, and they're like, yeah, we don't understand it either. So I don't feel like out naked and alone like that because of tips. But there are bonds that are that complicated. And so you need to really know what you're investing in. And, also consider the fact that if rates are going down, we're getting 5 to 5.25 right now on short-term bonds. If rates go down, we're not going to get that anymore, which means you should probably think of locking it in. Lock in a rate that's higher for longer. If you're worried it's going down a lot in the next year, and more or less, if you think that the market is mispricing that, which is more important, then maybe you should buy a longer term bond, like a 1 or 2 or 3 years. Just something to think about when you're okay. It was BP, yeah. Thanks, Doug. But if it is something that you are thinking about, you want to keep this rate, now's the time before things get really squirrely to think about what does the ladder of your bond portfolio look like? How far out are you buying? I'm buying short term because I'm good with short term. I'm perfectly happy getting that 5% because in my opinion, if it goes down much further, then it's not going to matter because at some point the markets will get squirrely, they'll go down a lot, and then I'll be able to buy it cheaper, and rates will probably be close to zero anyway, and then I'll be able to buy the stock market cheaper. So I look at it as it's a great hedge against a bad market. It's a great hedge against getting income when you're not getting it elsewhere. It works right now, and it'll work up until rates get really low, and then it won't work any longer, and then you have to find other solutions. So my point is you have to figure out what works for you. My strategy doesn't work for you. You need to come up with your own strategy, but you do need to understand how bonds work if you want to actively pursue them. International bonds have a different set of rules, the same set of rules, but you also have currency risk on top of it, which skews everything. So you could have a bond, it's a great bond, and then the currency goes not the way that you expect it, and all of a sudden you're losing money on bonds, not because of the bond, but because of the currency. So you have to be careful with international bonds. You could do really well. You can even do better in international bonds than you can with domestic bonds because of the currency piece. But you have to really understand the currency piece. A lot of people don't. That's like Forex. A lot of people don't understand it. And my business partner used to do this stuff professionally for Citigroup, so he understands Forex. But there are people I can count on one hand that I know that understand currency really well. So if you're in the global macro space, you do. Most people don't try it. Just stick with something that is currency hedged, or stick with US is easier. And I would look at it that way, because otherwise you're setting yourself up for issues. We're gonna have to wrap it up here in the interest of time. So Doug, final thoughts and take us home here.
Yeah, currency, and I appreciate that you talked about the currency risk on the foreign bonds. I mean, currency risk is a massive issue for international of any kind, and and I think is going to be something that's going to be here to stay, because especially now that we don't only know the impact of the of the Saudi and U.S. Non-continuation. Oh, by the way, you were talking
We don't know
about
the impact. We just don't like it.
We just don't like it, right? It's not a great thing, but we haven't felt the impact.
We haven't felt it yet.
Which means that it's going to be more and more countries are going to be able to use their own currencies and rely less on the dollar. That's not great for the dollar's long-term opportunities. But all of that goes into play, whether you're investing in domestic or foreign international companies. It's going to come into play whether you're investing in domestic companies that have international revenue, and it's definitely going to have an impact on how you can look at the impact of bonds domestically and international. I mean, it's just the trickle down. By the way, you said something earlier. You were wondering what the term was for saying that if there is a decline of an exponential, I think it's called exponential decay. That's so, and if something is rising rapidly and then it's just kind of slowing down. The other thing I want to say, and this is a humorous thing for Kirk and I. We had just talked in another, we talk all the time about chart crimes. I think here's a possible chart crime we could take, we take a look at. International does better in certain cycles against the domestic, U.S. domestic, worse, in certain cycles. Maybe it correlates to the solar cycle. Maybe we're going to find a correlation there that, as right now, the sun is the strongest point, and that is correlated with the run up of the S&P. And now we're going to be going into the waning. International's coming back. I mean, to me, that's a perfect, natural, easy, and no data behind it correlation there, Kirk, that I'm going to stick with.
It's true. It's on the internet, Doug, so it must be true.
It is on the internet. As a matter of fact, I will say I did find someone on a fairly arguably reputable site that actually has an entire list of charts and data about how solar cycles correlate to equity markets. I'm not going to get into it right now, but somebody's actually trying to put this stuff together. But if you would like to understand about, obviously, the impact of currency, the biggest impact to you is having enough, right? And how does that matter? Because obviously you're going to need currency in order to have enough money for the things that you love, the things that you want and need. And one of the things we work on is, when we're working with clients or helping to provide this financial education, is helping you to have enough money for the things that you want. The things that you need, so that you'll be able to have enough money to do the things that you want. And one of those things that whether or not you consider it a want or a need, is education planning. And so again, if you're listening to this, you can find out more about how to prepare to have enough liquidity and currency for college. I know you're stressed out there. I get it every day. People are finding out that college is costing more than they thought it would. Don't wait till it's too late. This is something you can start planning years in advance, but maybe you've got someone in high school and you're just bearing down on that date. Now it's critical to get that information. Check us out, Emergent College Advisors. Learn a little bit more information, get some free information on how you can prepare to cut that off before it comes too late.
Great. Well, thanks for coming on the show, Doug, and your wisdom. And I highly recommend everyone check out Doug if you have kids who are thinking of going to college. If they're anywhere from 8th grade up to senior, it's a great time to explore that. I can tell you from experience in working with Doug and other families on this that if you wait until the last minute, you lose options. Now, if your kid's 1 year old, you don't need to start that early. But if your kid is 8th to junior, it's a great time to start because the longer you wait, the more tools you lose the ability to employ. So
that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.